Bitcoin adoption has been hindered by a fundamental misunderstanding of its true nature, primarily because it has been grouped under the umbrella term cryptocurrency. This label leads people to assume that Bitcoin functions like traditional currencies such as the euro, dollar, yen, or shekel. As a result, they think of Bitcoin solely as a medium of exchange. Their immediate reactions are often centered around the fact that Bitcoin is not legal tender, making it tax inefficient to trade, and that it is not endorsed by their government as a preferred currency.
The adoption of Bitcoin has been hindered by a widespread misunderstanding of its true nature, largely due to its association with the broader cryptocurrency industry. The term cryptocurrency immediately prompts people to think of it as a form of currency akin to the euro, dollar, yen, or other fiat currencies. However, Bitcoin's true essence diverges significantly from traditional currencies. Bitcoin is often perceived as a medium of exchange like the currencies issued by governments. People then draw conclusions based on this misunderstanding. They assume it's not legal tender, making it tax inefficient for transactions, and they also perceive it as less favored by governments, potentially viewing it as a challenge to official currencies. Moreover, the volatility and perceived instability of Bitcoin further reinforce skepticism, as people believe nothing is priced in it reliably. This perspective overlooks Bitcoin's actual role and value proposition. Bitcoin functions more as a store of value or digital asset, akin to gold or other commodities, rather than a direct medium of exchange. Its decentralized nature and finite supply set it apart from traditional currencies, offering unique characteristics such as censorship resistance and inflation resistance. As we move forward, educating the public about Bitcoin's true nature and potential beyond the misconceptions associated with cryptocurrency will be crucial. Recognizing Bitcoin's role as a digital store of value and understanding its technological underpinnings can shift perceptions and foster greater acceptance and integration into mainstream financial systems. Expanding on the misunderstanding surrounding Bitcoin helps clarify its distinct role and potential, paving the way for a more nuanced understanding among investors and the public alike.
ETFs are applications on the Bitcoin network that securitize Bitcoin and play a crucial role in adding value to the cryptocurrency. They address several key issues, making Bitcoin more convenient to purchase. For instance, a 70-year-old retiree can easily pick up the phone and instruct their financial advisor to allocate 10% of their assets to Bitcoin, purchasing it over the next week at the average price. This accessibility and ease of use enhance Bitcoin's appeal and adoption among a broader range of investors.
Bitcoin ETFs represent a significant evolution within the Bitcoin ecosystem by essentially securitizing Bitcoin. This creates a financial product derived from Bitcoin's value, allowing traditional investors to gain exposure without directly holding or managing the cryptocurrency. These ETFs address key challenges in Bitcoin adoption. Firstly, they enhance convenience and accessibility. For example, a 70-year-old retiree wishing to allocate 10% of their assets to Bitcoin can easily do so by contacting their broker or financial advisor to invest in a Bitcoin ETF. This process simplifies purchasing Bitcoin by averaging the price over time, providing a familiar and straightforward investment method. Secondly, Bitcoin ETFs contribute to liquidity and price stability within the market. By pooling investor funds and trading on major exchanges, ETFs increase trading volumes and market depth. This liquidity facilitates easier entry and exit for both large institutions and retail investors without significantly impacting Bitcoin's price. Additionally, Bitcoin ETFs offer regulatory oversight and investor protections often lacking in direct cryptocurrency investments. They adhere to established financial regulations, providing a level of security and assurance to investors wary of the cryptocurrency market's volatility and regulatory uncertainties. In conclusion, Bitcoin ETFs bridge the traditional financial system and the digital asset space. They simplify access to Bitcoin, improve liquidity, and offer regulatory compliance, all contributing to the mainstream acceptance and adoption of Bitcoin as a legitimate asset class in the global investment landscape. Understanding the role of Bitcoin ETFs in improving accessibility, liquidity, and regulatory compliance provides a comprehensive view of their significance within the broader financial ecosystem.
When we had surplus cash on our balance sheet, our initial strategy was to use it for direct purchases. Subsequently, we earmarked some cash for a Dutch auction to buy back stock. With additional excess cash available, we decided to invest in Bitcoin. As the value of our stock surged, some employees exercised their stock options, providing more cash flow that we also allocated towards Bitcoin investments. Furthermore, profits from our software sales added to our cash reserves, allowing us to further increase our Bitcoin holdings. Towards the end of the year, when we found ourselves with leftover funds, we once again chose to invest in Bitcoin. Additionally, we seized an opportunity to issue a convertible bond to the market, and when demand exceeded expectations, we upsized the issuance, resulting in a substantial increase in our cash position.
When we found ourselves with surplus cash on our balance sheet, our initial strategy was straightforward. We used it to make strategic purchases. Following this, we earmarked funds for a Dutch auction aimed at buying back our own stock. With cash remaining after these strategic moves, we seized the opportunity to invest in Bitcoin, recognizing its potential as a store of value and a hedge against inflation. As our company's stocks surged in value due to market dynamics and employee stock option exercises, we experienced additional cash flow. Sensing the ongoing potential of Bitcoin, we continued to allocate these funds towards expanding our Bitcoin holdings. Furthermore, our software business yielded substantial returns through successful sales, resulting in excess cash at the end of the fiscal year. We chose to leverage this surplus by further investing in Bitcoin, aligning our financial strategy with the long-term growth potential of digital assets. Later, when an opportunity arose to issue a convertible bond to the market, responding to this strong market interest, we decided to increase the size of the bond offering, thereby bolstering our financial flexibility and reinforcing our commitment to strategic investments, including Bitcoin. Throughout these financial decisions, our approach has been to prudently diversify and maximize returns while embracing emerging opportunities in the digital economy. By strategically deploying surplus cash across various investments, including Bitcoin, we aim to enhance shareholder value and position ourselves for sustained growth in a rapidly evolving market landscape.